The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague and the king of chooks in Sydney, Anthony Macdonald. How are you, Anthony?
Yeah, I'm good, mate, and ready to croak.
Fantastic. This week, we're going to look at where the world's smartest investors think inflation goes next and share some of their best investment ideas. We'll extract the lessons from the US reporting season and look locally. And we'll also look ahead to 3 market-shaping events next week. But first, Anthony, it was great to catch up with you in Sydney this week for our Alpha Live conference, which we will get to in a minute. Obviously, like the President of America and the Vice President, we do need to take some special precautions when we have 2 chooks in the same city. We don't travel in the same vehicles and we have a special food taster, but it was good to see you again after my trip to Japan. Speaking of which, when I dialed in from Osaka, we said there was a potential Japanese deal in the air. And on Thursday, it actually happened. Can you tell us a little bit about that?
Yeah, there's always a Japanese deal in the air. Like every year or two, there's this big Japanese deal that seems to come from nowhere. You know, and it's always clean and quick and, you know, fully stitched up, big premium, well funded. And yeah, it was Blackmores. So sure enough, Blackmores has been in talks with a Japanese suitor, the beer company Kirin, which owns Lion in Australia, and Lion's the group that owns Tui's and Forex and Stone and Wood beer. Anyway, so Kirin's come for Blackmores, and it continues a long sort of line of Japanese companies swooping in and taking Australian brands. They like Australia. They see there's a bit of growth here, and Kirin think that Blackmores, they can use the vitamins and sell them up in Asia and beef out its own sort of health and pharmaceuticals offering.
Yeah, we should say Kirin's not just beer, particularly up in Japan. They're in a range of sectors, a huge range of sectors. Blackmores is an interesting story, though, Anthony. This was a stock that at one stage crashed through $200 a share. It was a glamour stock. People were stripping the shelves of their local chemist of Blackmore vitamins to send them to China. That story's faded a bit. So what does Kirin see in this business now?
Yeah, you're right. It was probably the hottest stock of probably 2015, 2016, back when Bellamy's was a big thing and it was all about infant formula and sort of exporting Australian products up into China. But yeah, it's all sort of changed. That China story's slowed down, but Blackmores still exports. A lot of its sales still come from exports up into Asia, including China. So, you know, Kirin thinks that they'll be able to continue to grow that business. So, I mean, good luck to them.
Marcus Blackmore, the biggest shareholder in the company, the son of the founder, he walks away with $245 million, I think it is. Do you think he's sad to see the company with his name on it go to Kirin, or glad to be rid of the thing?
Well, it's only come to this because Marcus Blackmore put his stake in play.
Yeah.
So he's had investment bankers working for him, approaching potential buyers. So, I mean, apparently he's convinced that Kirin's a good buyer and he likes to look at the deal. He's going to vote in favour of it. So you'd have to think that he's happy to rule a line under it and move on.
Yeah, and he hasn't been very friendly with Blackmore's board and management for the last little while. So, you know, all good things come to an end, I guess.
And James, we might be stretching the Japanese narrative a bit, but the Japanese are big buyers of Australian gas. They've been fretting about the prospect of the Australian government taking action to divert more gas to the domestic market and cap the price of gas sent offshore. Now, the government came out with an update in its plan this week. Should the Japanese be worried?
Oh, I think they'll still be a bit worried. We saw this plan unveiled late last year where the government said they would cap the price of gas at $12 a gigajoule. They've come up with an update on that. That cap will still remain. But in order to incentivise some more supply, they've put some exemptions in. So small producers of gas who only supply to the domestic market, they'll be exempt from the $12 cap. And large producers that can show that they're going to put a certain amount of gas into the domestic market, they'll also be able to get an exemption from the Australian Competition and Consumer Commission. But the question is, and the Japanese and the Koreans and other buyers of our gas will be asking this, are these tweaks enough to ensure that big companies continue to develop gas fields? Now, this is a question of time. We are going to not need gas in some number of decades, maybe 3, probably, hopefully less. But between now and then, we do need gas to continue to heat and power our homes and be used in heavy industry. And we also need it to firm up renewable energy. At some stage, we won't need gas as much as we do now, but between now and then, we're going to need it a fair bit. So who do we want to develop that gas? Probably the guys who are already doing it, the large gas producers, maybe some private equity firms, as we're seeing in the Origin deal. But are they going to be scared off by the fact that there's still this price cap on gas? It's not really clear to me why anyone would necessarily want to buy gas outside the price cap. So, okay, perhaps you'd want to do a deal with a small producer to guarantee supply for a longer period, and you're prepared to pay a bit more than $12. But most users are going to say, hey, I'd prefer to get the cap price gas than the uncapped price gas. I mean, that's just the natural economics of it. So the question is, is there enough of an incentive to keep the big guys investing in gas? And I'm not sure what the answer is. I think it's still unclear. There's more consultation to go here, but this is one where the government's trying to balance a lot of objectives. You got the industry minister wants the gas to be cheap for manufacturers. The energy minister wants to ensure that there's supply of gas. Jim Chalmers, the treasurer, wants to ensure that his tax take's not ruined. The minister for resources wants to make sure that the mining and energy sectors are happy. So you come up with this really complicated set of circumstances. It's definitely not a market-based price, is it, anymore?
Oh, yeah, it's extremely tortured policy. But like you said, everyone's looking for something out of this, right? And just as you wrote, I think the fact there were 4 ministers involved, I mean, it tells you everything you need to know, right? There's no easy solutions here, and it's going to take time.
Yeah, absolutely. Well, Anthony, let's move to our first major topic of the week, and that's inflation. In a bit of relief for the Reserve Bank, inflation for the March quarter did come in a little softer than economists expected. So that we had the headline rate of inflation moderating from 7.8% to 7% in the March quarter, and then the trimmed mean or core inflation, which takes out volatile things like energy and food, that fell from 6.9% to 6.6%. Now, money markets reacted immediately by slashing the odds of a rate rise next week from 30% at the start of the week to just 9% now, so basically no chance. But the question is, have markets got it right? Now, Anthony, I know we usually do the questions at the end of the podcast, but I am very excited to announce that we've got our first audio question this week. And I don't think it could be more appropriate to this discussion. So let's bring it up the order and let's play the question now.
G'day, James and Anthony. It's Sam from Melbourne here. Love the podcast. The increased inflation for the past 2 years to March 2023 has been 12%, and the last time we've seen an increase of that magnitude was the 2 years to March 1991. Whilst the world was obviously a different place then, unemployment was near enough to triple what it is now and continued to rise for about another 3 years, even though inflation shrunk precipitously in those same years. Do you think the market, and therefore its participants, have fallen into the trap of thinking things will be plain sailing as long as inflation retreats?
Well, thank you so much, Sam. You forever hold the title of our inaugural audio question asker. We'll get your certificate out to you soon. And Anthony, we don't really need to answer this question ourselves because this question of what inflation does next was central to the Alpha Live investment conference that the AFR held in Sydney this week. And my assessment of, I guess, the consensus from a number of people, the Future Fund CEO, Raphael Arndt, James Aitken, who's a well-known investor, several other fund managers, including Christopher Joy and Rob Arnott, they don't think inflation is going to fall away. And a bit like Sam suggests, they reckon money markets might have it wrong. And central banks, including the RBA, are going to have to do a lot more work to slay inflation. That might involve further rate hikes, or it might involve keeping rates on higher for longer. Were you convinced by this consensus argument?
Yeah, I'm convinced. I mean, the inflation problems stem from this government stimulus, and that's all in the system and cannot be changed. Now wages are hitting, so the wage increases are hitting bank accounts. There's EBAs that have been negotiated with above sort of 2-3% pay rises baked in for the next few years. They'll be coming through the system. Things like in the aged care sector, there's a 15% wage rise coming there. And, I'm not saying people don't deserve these pay rises, but clearly it's all more money in the system, higher cost of doing business, higher prices. So I think, we've all got to prepare for inflation being around for a while. The job market is also hot. So it's just up to the RBA, right? So do they want to stomp it out? And if they do, they've got the tool to do it.
Yeah.
But it's a big call for Philip Lowe. And going back to what we were talking about last week with fiscal and monetary policy maybe working closer together, he'll be pretty keen to see the budget, I think. Make sure that there's not too much in there to stoke all this along and make him look like the bad guy.
Yeah, good point. I thought the really interesting point was made by James Aitken, who pointed out that would be extraordinary if we were to get inflation under control with real interest rates. So that's interest rates adjusted for inflation, still deeply negative. I think they're minus 3.3% at the moment, or around that number. So I think that's a pretty powerful argument. But the consensus from economists, Ant, is that really the RBA wants to go on hold and stay there if it can, as it lets the prior interest rate rises they've done over the last 12 months take effect, and we get that lag effect. So, Anthony, you had a great session at the Alpha Live panel with some of our most powerful investors. These are the government-owned sovereign wealth funds who manage taxpayers' money. What was your sense from them on where they see inflation and markets going?
The sovereign wealth funds have all done really well, right? I think there's general acknowledgement amongst them that they've been able to make 10% a year in the past decade without doing too much radical. But the problem is maybe the good times are over. That's the sort of message they came to the conference with. So for the past decade, their CPI plus hurdles were pretty easy for them to smash, right? Like the inflation was low and there was plenty of returns out there. Now it's kind of the other way around. Inflation's high and they're having to look around for returns. Like the future fund boss, Raf Arndt, he said it himself. He said just having capital isn't enough to get decent returns anymore. Yeah. Now, in terms of what the sovereign wealth funds expect in returns, like it's such a simple question, but it's hard to get a simple answer out of them. Yes. Because they're more thinking about risk first and return second. Probably the most straightforward was the New Zealand Super Fund that said that they reckon that 8.5% is sort of the number that's achievable in the next decade. Right. And much of that should be fueled by inflation, really. Yes. For them. So they're not too worried about sort of hitting that 8.5%, but that 10% looks like a really big stretch. Yeah. It was interesting, Anthony, that some of the things they're doing, the future funds, not so excited about stocks at the moment, not so excited about bonds, more excited about commodities and real assets, so actual stuff like property and roads and bits of infrastructure. Not necessarily that easy for the ordinary investor to replicate that, but I guess one of the other things we heard a lot about was gold. Everybody loves gold at the moment, and several investors at Alpha Live were excited about gold. Yeah, and the future fund's been buying it. The reminder was that, like, we love sitting here and talking about companies, right? And all days fund managers chew our ear offs about companies and, ANZ's better than Westpac or BHP's better than Rio or whatever. But the sovereigns, it's all about portfolio allocation, and at the end of the day, they've got the big money. That's what's really driving markets out there. It's when they flick the switch and they're sort of in their risk on, risk off move and moving money between bonds and equities or equities and real assets or whatever. That's the liquidity in the market. That's really what's driving the big moves. And the future fund said that's where they spend their time, right? Because that's where their returns are. Yeah. James, you spoke with a really interesting investor from England, a guy called James Montier, who made the point that share markets are generally looking pretty expensive still. Do you agree with him? Yeah, he made a compelling argument, and it's interesting. We've seen quite an impressive rally in US stocks. So the S&P 500's up a bit over 8% since the start of the year. But
his point was that puts US stocks on a valuation of 30 times earnings, which is pretty eye-watering. The long-term average is somewhere more around between 15, around 15 times, I guess. So where he's looking, though, is emerging markets. So he's really excited about everything outside the US and Europe and things, places like China. He's even interested in Japan. And what he's arguing there is you can buy those markets on single-digit multiples. So, between under 10 times earnings. And he was saying that when you do that, when you manage to buy a market for under 10 to 13 times earnings, usually your capital's pretty safe. Please don't take this as this is general. This is general statements. This is not personal investment advice, of course. So that's where he's looking. Japan even was another market that he's interested in. But I think it's a good point to remember. We've seen this real crowding into tech stocks, particularly big tech stocks like Amazon and Apple, Microsoft. They've really driven the US market since the start of the year, and they are looking very overcrowded and very expensive. So I think Montier's got a really good point. He was a really interesting guy. Lots of stuff about the danger, I guess, of investors' biases hurting their returns. At the moment, everybody's being very selective with the information that they look at. So if you're bearish or if you're bullish, you're looking to find bits of information that confirm your point of view rather than doing the right thing and being skeptical about your point of view and thinking, what am I missing? What am I getting wrong? Where could I have stuffed this up? So I think that was that was one of the best things I took from the conference, actually, Anthony, that reminder to be skeptical at all times and challenge yourself. What were some of your best investment ideas that you got from Alpha Live?
Yeah, well, Hassan Tefik, one of the fund managers on the Monday Fundy panel, brought up the contractors like Downer and Lendlease, and I'd just come from Downer's Investor Day, so I was already sort of thinking about them, and he reckons it's a bit too early to get involved in their turnaround, and I sort of tend to agree with him, right? Like, contracting is such hard work. They've got so many tailwinds at their back, right? Infrastructure spending, energy transition spending, defense spending. But who's going to make money out of all this, And I mean, history tells us it's probably not the contractor. So anyway, good luck to Downer. I hope their turnaround goes well. The new CEO seems like a hardworking and honest executive, but he's certainly got a big job. In terms of the broader theme, I thought that when the future funds start talking that they're getting into commodities and buying commodities, I think that's something that people should listen to. I mean, obviously it's hard for the everyday investor to do that sort of things, but when it comes to something like copper, there's no doubt that the demand for copper is going through the roof, right? The electrification of everything is happening all around us. It's going to be a story that plays out for the next 10 or 20 years. We all know there's finite reserves. So, I mean, I thought that was interesting. What about you? Did you pick up any ideas?
Well, look, I thought Crispin Murray, who's the head of equities at Pendal Group, he was very upbeat about Qantas. That stock's up sort of 20% in the last year. So you might have thought, well, it's run its race, and obviously no shortage of criticism of Qantas seemingly every day. But his argument was that this stock can run further because the shape of the aviation industry has changed. So obviously Virgin's coming back, but they're off they're still a turnaround story. And so Qantas has the ability to get better margins and better returns in this cycle than it did prior to the pandemic, and yet the stock's still trading at below its pre-pandemic levels. So, I thought that was an interesting one. The other we had a great session with short sellers who always attract plenty of interest. So these are the guys who basically bet that a stock's price is going to fall rather than go up. And they had some great red flags about companies. The sort of main ones was for looking when executives or board members sell stock, or when they leave suddenly. Particularly if the person leaving is the chief financial officer. So that's a major red flag. Doug Tynan, one of the short sellers on that panel, had a fantastic one about the number 4. So They use an algorithm to do statistical analysis of different companies' statements. And if the number 4 is less frequent in those statements, and that's a red flag. Now, why? Because CFOs don't like the number 4, because if they prefer the number 5, because that lets you round the number up.
Of course.
And so if a company's staying away from number 4s, that could say they're being a bit aggressive with their accounting, which I thought was a left field way of looking at the world, but sort of pretty cool, I reckon.
Yeah, you got to love the short sellers. They're just brave enough to say what we're all sort of thinking, right? They
That's
can
right.
really strip it back to basics, cut out the crap that gets shoved down our throats a lot of the time, and just sort of be quite clear-headed.
Yeah. And I think we love them, Ant, because they're sort of like the journalists in the market. They're the real skeptics who see the red flags and put their money on the line to back them. So look, Alpha Live, great event. It was the first one, and I'm already looking forward to 2024's edition. It's just so many good ideas. I've still found myself today thinking of a few things that will pop up into my head, and that's the sign of a really good event. So congratulations to all involved, particularly John Shapiro and Vesna Polyak at our shop.
Okay, moving to our second topic of the day. Well, James, we got another little window into the problem of sticky inflation this week from the United States, where investors there are deep in the throes of March quarterly earnings season. And in Australia, we're waking up to these numbers every morning.
Yes.
Now, James, you had a look at a few results from the likes of Coca-Cola, Procter & Gamble and McDonald's, all big players in this market too. What did you see there?
Well, look, I see what we saw is no signs that these guys are pulling back from pushing through higher prices. In all cases, volume growth was either relatively muted, 3%, or in some of the cases, Procter & Gamble, for example, volume growth went down, but revenue went up double digits because they're pushing through huge price increases still, 10%, 11%. And why are they able to do that? Because demand is still strong in right across the world, particularly in America. So all these, this narrative that we're heading for a US recession, you look at the likes of Coca-Cola, McDonald's, Procter & Gamble, Chipotle, you name the consumer business, they're not seeing a recession coming anytime soon. So it'll be really interesting as we get to our reporting season to see whether the same trends are holding and whether companies are able to hold their margins or even increase them a touch because they're able to push through these price hikes.
Yeah, it seems to show that stimulus is still very much in the system, right?
Yeah, for sure.
What about the tech companies? We saw some pretty impressive tech earnings, didn't we? Maybe from Microsoft.
Yeah, I'm a bit torn on this. The tech sector has been driving the market, as I said earlier. I think there's 5 companies: Microsoft, Amazon, Apple, Nvidia, which is a big tech company, and Meta Platforms, which is the Facebook owner. Those 5 companies, that they account for 2/3 of the rise in the S&P 500. So people are crowding into these stocks. I've described it as panic buying. Usually we get panic selling, but people are panic buying these things because they don't want to be left behind from the really the only winners in town. So we had results from the likes of Microsoft, Facebook, Alphabet, and Amazon this week. Microsoft was a really good result. The others were a bit tepid, I thought. I mean, their revenue growth at Alphabet and Facebook was 3%. I mean, in a market where inflation's running at 5.5%, that's not too flash.
Yeah.
And so I just wonder, are these stocks starting to get expensive, given that their prices have risen really because investors are hoping that the Fed cuts rates at some stage and that the economy doesn't slow. And we don't really know that either of those two things could happen. The other thing is there was a lot of talk about AI on these calls. I think on the Alphabet call, there was 53 mentions of artificial intelligence. They're really ramming this hype. And a lot of these AI stocks have added huge amounts of market capitalization. Where do you stand on the AI thing? Any risk we're overdoing the hype, given it's a little hard to figure out who's actually making the money at this stage?
Yeah, well, it depends on your time frame, doesn't it?
Yeah.
I mean, if you look at if you look at the way these things have run, then yeah, sure enough, maybe you missed the boat to get in the near term. But I mean, the longer term story for AI is so compelling. Just as similar to what copper, like I was saying before. Like if you just look at Australia, we've got unemployment at I think 3.6%. There's plenty of job vacancies. We're about to embark on this biggest CapEx program of our lifetimes, the energy transition. We need more staff for aged care homes. We need more nurses. We need more teachers. Immigration is going to go some way to solving the problem, but clearly we need to find more people to do jobs and lift productivity.
Yeah.
But there's not going to be enough people around to do it, right? So we're going to be looking to technology and AI and things like that to help fill the gap.
Funny you mention aged care. I mean, you wouldn't think AI is going to be doing a lot there, but I did a panel this week with Mike Baird, the former Premier of New South Wales and former NAB banker, now runs a big aged care business called Hammond Care. He said, we're already looking at AI because we want to use it to try and predict things that are going to happen in people's care. Who might be about to have a fall? Who might need a different level of care from their health care staff? So even in those businesses, a relatively small business compared to, Meta or Microsoft, it's still being that they're still looking for ways to ride this wave. So you're right. One other thing, Ant, we're in quarterly reporting season here, which is mostly about mining companies. Any surprises or things you'd call out from the week's results?
Yeah, Perth's Mineral Resources probably knocked around the most from a share price perspective. It was down about 10% on the day. It pointed to persistent cost pressures. Volumes were down in its services business. Its lithium volumes down. There's price downgrades. It was generally just pretty soggy. It's carrying a bit of debt as well. So I think on Morgan Stanley analysts' expectations, that debt could be worth about 2.5 times FY24 earnings, which is quite a bit for that company. So I think it's more just, it's just a bit of caution around it. But, I think most of the quarterlies sailed through. I mean, speaking of quarterlies, management teams have been out meeting fund managers post the quarterlies, and we bumped into Fortescue's new lineup in Sydney on Wednesday this week with, Andrew Forrest as the chairman, obviously, and he's got his new CEO of Fortescue Metals side, Fiona Hick, and then the Fortescue Future Industries boss, Mark Hutchinson, and he kind of talks about it like a co-CEO model. What do you think of the new lineup?
Oh, well, look, I mean, we were able to have an informal meeting with them and great to meet all the team. Going to be an interesting model. 3 really smart people in one room, and it's going to be fascinating to watch how it works. I think they're all committed to making this sort of unique model work, and that they're right behind it. So I know they've been meeting investors, and this is sort of their coming out party. So we'll be hearing a lot more from that trio as we go forward. Well, Anthony, if you thought this week was big, there is some serious market-moving stuff next week, and we'll get back into all of that right after the break. Okay, Anthony, it is going to be a super big week for the Chook team. You are off to the Macquarie Conference in Sydney, which starts on Tuesday. Now, this is known as the start of confession season. Tell us a little bit about what confession season is and what you're expecting. Yeah,
so companies and their boards are getting closer to their June 30 balance dates. They should have a pretty good idea about what their June 30 numbers will look like now. If they're out of line with what the company said previously or the market's expectations, now's the time to confess, basically, either on the upside or the downside. And typically we expect these things on the downside because most of us start life with glass half full approach and then have to cut back to reality. So the Macquarie Conference is kind of generally seen in the Australian equities market as the dawn of confession season. It's the biggest investment conference. I think there's about 100 companies presenting next week. So, just in the first morning, it goes for 3 days. In the first morning alone, you've got Wesfarmers, Transurban Coles, Charter Hall, Stockland, Bank of Queensland. Like there's stacks. So that'd be great to go, and hopefully there's a bit of news from it.
Yeah, who are you thinking might spring a surprise on us?
We already know what the miners' numbers are like, and where the banks don't really feature. But I'm really interested to see some of the heavy sort of industrial companies, your Borrells, Fletcher, Seven Group, see what they're saying about the economy. Also keen to see the media companies like Nine Entertainment, our employer, and Seven West, see what they say about the advertising cycle, because we haven't had a lot of news on both of those fronts.
No. And I'd throw in the retailers, Anthony. Wesfarmers on the first morning, and I think Super Retail Group, they've been holding up really well. And I reckon the RBA will be interested in seeing how they're tracking and how consumer spending is holding up. Speaking of which, while you're at the conference on Tuesday, I'll be awaiting the RBA's decision. As we said earlier, money markets see it as a done deal, and there won't be a rate rise on Tuesday. Any chance they've got it wrong?
Well, I've been flooded with RBA previews this morning from all the brokers and the big banks, and they're all saying rates on hold, which is, this time last week, you and I both said they should hike. So if they hiked, I couldn't blame the RBA at all. I'm all for bringing it back to 2 to 3%. This job market's really strong.
I'm with you. I'm going to be wronger for longer and say that they're going to hike still. I'm in the James Aitken camp that inflation is not quelled. This is not the time to take the foot off the hiking accelerator. Another hike and then you can wait and see. But let's not let this get out of control. And the last one is banking reporting season kicks off next week. NAB on Thursday, and then we've got Macquarie and ANZ on Friday.
Yeah, the one I'm most looking forward to there, James, is definitely Macquarie. What I'm hearing out of Macquarie is the number's going to be massive. Oof. And all the staff are looking forward to it. The bonuses this year are going to be real, sort of really, really a lot better than everyone else on the street.
Right. Well, you'll get a better sense of that down at the Macquarie conference. If the wine has been upgraded to a better standard, then you'll be fine. All right. Well, we've had our question, but I will do our call out. Be like Sam Brannigan from Melbourne and send us an audio question. All you need to do is record a voice memo on your phone, include your name and where you're from, and email it to us at chanticleer@afr.com. If you don't want to do a voice message, you can email a question to us in written form too, and we'll do our best to get through those. Okay, I've got a couple of recommendations before we go. These come from our Alpha Live, and James Aitken was asked, he loves recommending books, and he was asked to recommend a few, so I'll share two of those. One's The Psychology of Money by Morgan Housel, and the other's called Outside Lies Magic by John Stilgoe. And what James Aitken said about these are books about investing in money, but what they're really about is how you tune out the noise of the daily markets and daily lives and buy yourself or find yourself time to think about the world and the bigger picture issues. And I think the second one, Outside Lies Magic, is about sort of how nature can help you do that. So James Aitken said it all sounds a bit wishy-washy, but it's actually really interesting. So there's two recommendations. And finally, Anthony, Rob Arnott gave us a wine recommendation, and that's the Torbreck Syrah called The Laird. Now, I wrote about this in the column today. I've subsequently had a bit of feedback, Anthony.
Yeah.
It's $800 a bottle. So might be just out of the current Chanticleer team's price range, but we hope our dear colleague Tony Boyd is perhaps we got to see his impressive cellar recently, and I reckon a bottle of the Laird would fit well in there. What do you think?
I reckon he's already got a couple.
All right. Well, Anthony, we look forward to being invited over to Tony's house to try the Laird. But in the meantime, thanks for today, and we'll see you next week.
Yeah, see you next week, James.
Well, if you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Spotify or Apple or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd. The producers are Lap Fan and Alex Gow. Our theme music is by Alex Gow. See you next week.
Australian Financial Review.